Hey, everybody. Welcome to Condors, Calendars, and Butterflies. My name is Brent Morse. It's Friday, everybody. And this week, I want to hit up a type of strategy that we're kind of doing a series of strategies. Last time we met, which was a couple weeks ago because of the Thanksgiving holiday, we talked about front ratio spreads. They kind of had one glaring kind of shortcoming, and that was this kind of unlimited loss potential, which we don't love so much. This week, we're going to do something different, slightly different, that is going to help to try and fix that big glaring issue that we had last time, and that is we're going to do back ratio spreads. We're going to look at those today in just a few minutes. Now, I'm joined alongside Mr. James Boyd helping me out in the chat, so as you have questions, feel free to type those in the chat between James and myself. We'll do our best to get those questions answered. Also, you can follow James or myself on X at Brent Morse CS, at James Boyd CS for additional content, financial related content we post throughout the week on X. And I see some familiar names in the chat. Glad you're here. Thank you. Hey, let's talk about, let's just go through disclosures real quick, and then we'll get to the reason you're here. Options do carry a high level of risk and are not suitable for all investors. And the material today is intended for general informational purposes only and educational purposes only. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And the paper money virtual trading application will not assign those short options early. So that's a difference between paper money and the real life Thinkorswim platform. But just know that those differences do exist. And, consider liquidity as you're trading these. All investing involves risk, including loss of principal. Past performance is no guarantee of future results. Schwab does not recommend the use of technical analysis as the sole means of investment research. And there's no guarantee that an execution of a stop order will be at or near the stop price. Hey, let's head on over to the Thinkorswim platform. Just take a look. Where are we at? We're up a smidge today on the S&P 500. But in general, we're still kind of hanging in there strong above the 20-day, above the 50-day. The general trends have been going up. Now, I mentioned we're going to talk about back ratio spreads here today. Now, one thing I just want to point out is if you're interested in other strategies, you can find those other strategies on the playlist for this webcast on YouTube. I'm going to put a link to that playlist in the chat for those of you watching live. For those of you watching on the recording, just go to the Trader Talks channel on Schwab and look at the different playlists, and you'll see different playlists listed there. You can see a whole bunch of playlists, including playlists that have webcasts generated from Mr. James Boyd, such as the Investor Master Series playlist, and this playlist. Encourage you to check out some past sessions there. But this week, what we're going to do is we're going to focus on back ratio spreads. And let me just tell you something about back ratio spreads. You can do them with calls or puts. It's true with most option strategies, right? You can do short verticals with calls or puts. You can do calendars with calls or puts. Same thing with back ratio spreads. And if you do a call, it's going to be bullish. If you do a put, it's going to be bearish. So that's kind of the first thing I want to just mention to that. And what we have with these is we're going to have more long contracts than short contracts. That's the difference from last week. Last week, we had more short contracts than long contracts. That's where we got that unlimited risk issue that we came up with. This week, there's still risk. I want you to be aware of that risk. But since we have more long contracts than short contracts, now it can be a 2-to-1 ratio, it can be 3-to-2 ratio. You can make up whatever ratio you want, but a ratio spread has a different number of calls, different number of contracts. So we're going to have more long contracts and short contracts. Now, here's the thing. As comparing this to a front ratio spread, they're more expensive, but you also have unlimited profit potential. That sounds good. Let's take a look at it. So I'm going to pull up a stock that's in the news today. NFLX, Netflix. So they just announced they're buying Warner Brothers Discovery in a, I don't even remember how big the deal, how many billion-dollar deal it is. But there's a big but on this. And this is, it's in the news today because, in fact, I thought this was interesting. If you pull up the headlines on Netflix here, and this, and what you're going to see is they announce, oh, we're going to buy this. And then you see this headline. Senator Elizabeth Warren says Netflix Warner deal could be anti-monopoly nightmare. Okay, so that's kind of the left side of the aisle, so to speak. You scroll down a little bit, and where is it? There's another article here that says I don't see it right now. Oh, yeah. White House official says administration skeptical of Netflix Warner Brothers deal. Okay. And so as you look through these, pretty much there's a lot of negativity, a lot of antitrust concerns here with the deal actually seeing the light of day. So we'll see if it goes through or not. These deals take a long time to go through if they get approved. I don't know if it will or not, but yeah, 80. So in the chat, thank you for helping me out there. $82 billion deal there. So, do I have any special insight as to whether this thing is going to go through? No. What I'm going to do though is I'm going to say, I'm not even going to worry about that right now. What I'm going to do is I'm going to look at what the market's doing. And what the market has been doing on Netflix is it's been selling it off. And my assumption is it's going to continue to sell off. We have lower highs and lower lows. Okay. We had a lower low that maybe was going to hold up as a support. No, we broke through that. Okay. We're below our 20, below our 50. Both are sloping down. Little bit of, we're off the lows of today. We're still down about 3% today on this. So I'm going to take more of a bearish look at Netflix today. A little bit more of a bearish look. So let's go through a trade here on this. So because these are puts, because this is bearish, I'm going to look at some puts here. Now you got to kind of figure out your time frame here. On this, I'm going to go out about a month to start. And we'll do a different example where we don't go out a month, but very often we'll go out kind of a month on these here. It just kind of depends on your time frame. You could do them out a week if you think the stock is going to move that quickly. If I felt this were just going to rocket down real quick, maybe a week. But in this case, that's not my assumption. I'm going to give it a little time to work out. So I'm going to go to January 2nd here. Now, you do need to be careful about liquidity on these. Netflix is a pretty heavily traded stock, so I have fewer concerns on this. But you can certainly look at your bid-ask spreads on these. And I'm going to look at the put side of the equation here. Calls are over here. Puts are over here. And for our purposes, now you don't have to pick the exact strikes I'm going to do here. Stock's right at 100. But I'm going to sell right at the money. I'm going to sell the 100. Is it still a back ratio spread if you do a different strike? Yeah, you can do that. But I'm going to sell that 100 strike. Okay. So I'm just going to click on that bid price. Now, what I'm going to do here is I'm going to go in the money. I'm going to go in the money for a put is going to go up here. Now, how far am I going to go? What I'm going to do is I'm going to look at the intrinsic value of this. Okay. So it's about 350 roughly. I said intrinsic, I meant extrinsic value. It's about roughly 350. And basically what I'm going to want is I want a couple contracts that are more or less going to equal the 350, which would be about 175 or so in terms of the intrinsic value here. Okay, so we'll call that close enough. Extrinsic value, I said intrinsic value, again, I meant extrinsic value. And I'm going to do a couple contracts here of that, okay, of the 104.50. I'm buying those. So let's just look at a kind of a summary of what we got here for this trade. And then we'll look at we'll analyze it and just kind of decide, Well, why would we do it? We'll discuss further why we do this. These are puts, okay, because we're bearish, number one. Number two, I sold one contract, you can't see that right here, but it's one contract of the at the money contract here. And that's generally how we're going to do it here. Let me just make my marker a little less thick here. We bought two in the money contracts. The two in the money contracts have an extrinsic value that more or less, you're not going to get it equal exactly probably, but it's going to more or less equal the extrinsic value of the one other contract, of the one contract that we sold, okay? It's a debit spread. It's going to cost us more. It costs us more than it did last week, but there's some pros on this trade. Let's just take a look at it here and see what it looks like. Of course, if you weren't bearish on Netflix, you want to do this trade, okay? Here's what it looks like. Let me just make sure I have no extraneous trades down there. Nope, that looks good. And here's what I want you to look at. Number one, look at where our break even is on this. Our break even is right where the stock is there, okay? So that's our break even. That means roughly we're going to have a 50-50 probability on this, positive or negative. Look at this though. This is different than last week. The more this stock goes our direction, in this case down, the more money we make. I could scroll this over and this line would just keep on going up, over and over, keep on going up. Now, here's another difference from last week. If it goes against us, in this case against us means bullish, the stock goes up, look, it gets worse. We lose money, right? We lose money. But it caps out at our strike. Our strike was 104.50. 104.50. That's where if this flattens out right there. Okay. Now, here's another thing to notice. That's at expiration. Look before expiration. There's a difference here. This is what the trade looks like now. This is what it's going to look like on expiration. In other words, if we get a quick move here on this against us, then we're probably not going to be, I can't make any guarantees, but we're probably not going to be near the loss that we would be at expiration on that. Okay, you see that? That's not the case up here. Up here, just clear that up. Notice the purple line and the blue line are kind of like almost right on top of each other. So that tells me there's a much bigger theta difference, a time difference here on if it goes against us than if it goes for us there. So in other words, we can realize our profits a little quicker. Our losses, if it goes against us, we're not going to get to that max loss as quickly, most likely. We're still going to want to exit out at some point. We're still going to put a stop on it or some sort of exit on this. Where should that stop be? Well, let's go back. Let's look at our chart. Okay. And what I'm going to say is, look, this was my old support that we broke through. I'm going to call this a new resistance. I'm going to assume the stock's going to stay below here. If it starts to break above here, which is about 104, if it starts to break above there, then I'm just going to look to exit out. So I'm going to exit above 104. Have your exits. So what kind of exits are we going to do on this? So and what other qualities of this trade? Let me just go back to that Analyze tab with a couple things I want to point out. One, time decay. Well, we have two long contracts, one short. We do have some negative theta there. Now that theta is less than if we didn't have the short contract. And the nice thing is, because the short contract is at the money, where time decay is helping us out, and those long contracts are in the money a little ways, the time decay is going to be a little less on those in the money contracts typically. One reason we go for try and make that extrinsic value equal, of the long contracts equal the short contracts, is to minimize the time decay. It's to help, you're still going to have some time decay on this, but it's going to help to minimize that time decay. All right. So that's why we do the extrinsic value thing on that. Vega positive. I saw someone, I think it was Chris earlier, said Vega positive. It is a Vega positive trade. Yeah. Now, time decay, theta and Vega and gamma, I guess, aren't they switch depending on what the stock does. Okay. And so, those are variable. They can certainly change. They can certainly change on that. All right. Now, this is not, well, let's move on. We have our exits. We're also not going to hold it all the way to expiration. Okay. But let's take a look at this. Let me just kind of write out just real quickly what we're doing here for those of you who like to kind of take notes on this. And keep in mind, this isn't a universal recommendation or anything, but this is just some characteristics of what they are, or how we're going to kind of do them in this particular webcast. They can be calls or puts. Okay, calls are going to be bullish, puts are going to be bearish. Okay, you have more long contracts than short contracts. Okay, they're more expensive than front ratio spreads. Okay, but have unlimited profit potential or very large profit potential, okay, or very large, if not unlimited. Same thing we said on front ratio spreads last week in terms of the loss potential. Some of them don't necessarily have unlimited loss potential, but they can be very big there, okay? Your max loss is to the out of the money side of the trade, okay? So in this case, with puts, our max loss is going to be if the stock goes up on that, okay? We're going to often look, well, actually, let me do this. Let me go in order. I have some notes written down. The way we're going to do it is typically we're going to do one at the money, ATM, at the money, short option. Two, again, we can change the ratio if we want. In the money, long options. We often seek zero extrinsic value in an effort to kind of help minimize the theta there on there. Let's see. Typically, if you do them this way, they're going to be close to 50-50 probability. And the downside is limited. There you go. Let's keep on moving here. And we'll get to, I see your question here. Chris says, would you say these are best when you expect IV rising? Yeah, you would, because these are, although they're negative theta, they're positive Vega. And I didn't look at this specifically, delta often near 100. Okay. You can do various ratios, We already mentioned that. Any expiration date, but should match your forecast. And just a couple more. exit on stock targets. And finally, we're going to exit less than 10 days to expiration. Okay, so there's that. If you wanted to take a screenshot of that, you can. But let's go back to this and let's go back to our trade. Let's go back to our Netflix trade and actually look at placing the trade here. Okay, so this is what it looks like. Now, once you have this, you can tweak this, of course. If instead of these strikes, what's going to happen if I change this? Well, look, I can shift this. As much as I shift these strikes down, it's just going to shift this basically an equal amount on the graph there. But to get like the 50-50 probability here on this of 50% above break even, 50% below break even, that's what we have there. Now, one question that sometimes we'll get, let me just see if I can break this up here. Is it going to let me break that up? Change these? Yeah, well, okay. So one question that sometimes we get is, hey, look, I'm interested in a long put instead of doing a put back ratio spread. What's the difference? Well, let me mention this here. In general, I've looked at a lot of these, and so I'm going to kind of generalize here between just doing a single long option and doing one of these back ratio spreads. And that is, look, here's our break even right here. We want the stock to go down. If I were just to do a long put, my break even would be, I would need the stock to move more, okay? I'd have a less favorable break even, most likely, if I just do a single, the single long option on that, okay? Probably, and this sometimes varies a little bit, we're probably going to have a greater theta, greater time decay working against us if we just do the long single option. So why do we ever do long single options instead of this? The answer is our risk is greater on this than the long single option. This is an $840 risk. If we were just to go to the long option, what's the cost on that? Oh, come on, it locked. Let me undo that. But that's not, I don't know why that's being really screwy there. It's not liking that. Okay, it's not gonna let me do that. Okay. Our long option on this at the 104 strike, 104.50 strike is basically $580. So we are risking more than just on a long option. So those are pros and cons of just doing the long option versus the ratio spread. You know, it's not a right or wrong answer. It's what you feel is going to be better. So how do we do this trade? You got the trade set up. We're going to put that exit in. I said above 104. So I'm going to just add a first trigger sequential order. I'm going to right click on this. I'm going to create an opposite order. Opposite order is going to get us out of the long contract. It's going to sell the long contracts that we're in. It's going to buy back the short contracts that we're in. And I'm going to make this a market order. I'm going to make it good till canceled. I'm going to go to the little gear there. And I'm going to go and I'm going to say, well, if Netflix marks greater than or equal to, and we said 104 in this case, 104, enter, save that, confirm and send. Make sure you read the order confirmation dialog box carefully. There it is. It's a ratio spread, so you get this. And make sure you read the red too. Please note that you've selected weekly option series, which is what we intended to do. That's great. Okay. And I'm going to leave this in unallocated because I don't have a special bucket for back ratio spreads. Let me go and send that. There we go. We sent the order. Now, on this order right now, it has not filled. If I want it to fill, I can wait, which is typically what I'm going to do on this. But if I want to kind of force it along, push it along a little bit, I can just kind of right-click on it, cancel and replace it, and I can see, why is this not filling? Well, because my price isn't where I want it to be here. And we'll see if we can confirm and send. If we send that again, if that fills there, it filled. So now we got that filled there. Okay, now let me look at questions here. So let's see, looks like James got those. So thank you very much, James. And I think we talked about the IV. Now, we can certainly look at the IV on this. Now, Netflix, as we've been discussing, is kind of a news-driven stock right now. And I don't know what the news is going to be, but you can always look at that IV. Ideally, this is going to climb. We had earnings last on about October 21st, it looks like. November, December, January. So mid to late January, we're going to have earnings again. Typically, before earnings, you kind of get this with the IV. So that should help. It should help if the stock goes down with our IVs. If the stock reverses itself and goes up, the IVs may go down a little bit, which would work against us a little bit there. Yeah, JDLMI said, hey, like the risk and reward. That is a lot, looks a little better than last week, doesn't it, on that one? So there we go. Mary says, any concerns on light volume based on the holiday? No, not particularly. We are certainly going to have some lighter volume days. I would think, no doubt, that, you look at like the week of Christmas itself, that week will probably have some lighter volumes, no doubt. Right around, day before New Year's will be light volume. But all in all, looking at December in general, I don't think that's a huge concern there in this case. Okay, let's look. Now, I just gave you a bearish example. I wanted to do that. Let's look at maybe something that's a little bit more bullish here as another example on this. And so, of course, you can do anything, any kind of bullish stock you want to look at. And what I'm looking at here is trends, largely. This is a 20-day moving average, sloping up, stocks bouncing off it. Cisco's certainly a possibility. Liquid stock, okay? Cisco's pretty liquid typically. You got to check the individual options. Goldman Sachs, trend is up, breaking out. That's a certain, kind of a bullish type example trade. Trending up on Danaher, okay? That would be more of a bullish example trade. What about bearish? Bearish, we already looked at Netflix. What about Procter & Gamble? Trending down. Do you see a theme? I'm trading primarily off the trend here. Technical analysis isn't the only way to trade, but it's the way we focus in this webcast. There's my 20-day moving average. We're bouncing off of that. Those are the types of stocks. This one for bearish because it's trending down. Those others we were just looking at for bullish. MD, here's Mondelez. Mondelez, I would double check you can check the open interest. You can double check that bid-ask spread because just in my experience, sometimes Mondelez don't have the tightest spread. So sometimes you need to go to the monthly options for that, okay? But let's look at another more bullish type example. And here's Alphabet, okay? So Alphabet, again, trending up, higher highs, kind of a flaggish type pattern here. So I'm expecting to move up. Now, don't be concerned. That's not an earnings. That is a dividend. 21-cent dividend. The question often becomes, does that dividend going to affect the stock price much? Well, the dividend tends to affect the stock price by the amount of the dividend, okay? 21-cent dividend. So that's, multiply that by 4 because they're quarterly. That's about 80 cents a year. It's a $320 stock. Anyway, if it affects the stock by 21 cents, a $320 stock by 20 cents, it's not even probably going to be noticeable. You're probably going to notice it there. Okay. Now, question in the chat of what kind of scanner I use. I didn't use a scanner. I'll tell you what I did is I used a watch list. Okay. It's a watch list that I created that actually, I think I may have just used the S&P 100 watch list because they tend to be liquid stocks. Okay. That have liquid options. Not all of them. If you are going to scan, you may consider something kind of like, well, I have another one where basically I look at S&P 500 stocks. And I'm kind of taking a little tangent because I think it's a good question, an important question that David asked. And I'll go penny increment options. And let me just get rid of our existing. Okay, it's penny increment options, S&P 500 stocks. Then what I'll do is I'll go add filter. I'll do a study filter. You can't do that on paper money, but on your live platform, and then you can go to volume and go to average volume. And then what you can say is, I want my average volume to be at least, I don't know, 5 million, 8 million, 10 million. You got to count your zeros there. That is 1 million. I'm going to add one more zero there. Scan, and then you're going to get with more liquid stocks. Now, some of these will be bullish, some of these will be bearish. Once you save the scan, you go up to that middle 3-line menu, save the scan query. You can just say, title it whatever you want, liquid stocks or whatever is what I have. And then when I have that, I'll just scroll through it. Just make sure your chart's linked. And then I can easily see, that's kind of looking, it's turning over right now, right? You can use your technical analysis on that. Oh, there we go, trending down. And then you go and you may find, looking trending up, bullish. That's how I found those. So good question, not a specific scan. And by the way, any scan you do or scan that you save and then you have a watch list from, or if you just elect to use a watch list and have a column script of some sort or a column that you sort by, I haven't found one yet that's going to give me perfect trades, right? So what you need to do is the scan or the watch list narrows it down to a manageable number. And then what you can do is say, well, does it meet the last steps? Does it really fit what I'm going for? Because sometimes, you spend your time creating this perfect scan, or you think, it looks really good. And then you look at the stock and it doesn't work out on that. Okay. So a little tangent there, but I think it's an important one. So I'm bullish on this. The stock's at 320 right now. So therefore, using kind of the formula we've used, which isn't a recommendation necessarily, is what we're going to do is we're going to sell, okay, one contract at the money. And there should be a strike price right at 320 that we'll go to. I'm going to buy 2 contracts in the money, and we'll have to see what those strikes are that we use. That's the initial formula that we're going to use on this for this bullish trade. If it goes against us, and I'm going to say, this was my support. We just bounced off this. I don't know what price that is. Let's see what we got here. Let me get out of my little drawing tool. We'll say around, 310 will be a clear break of that probably. Let me just jot that down. Exit below 310 on this. Well, let's look at it. Okay. So also, how long are we planning on being in this? Well, I'm looking for a little flag bounce here. I'm not planning on being here. So 3 weeks is probably sufficient on this. Let's see what dates we have. We did Netflix, we did January 2nd. Here's December 26th. Okay. So we're not planning on holding it all the way to expiration. So the fact that that's the day out of Christmas, and this is after Christmas, and this is going to Mary's question earlier of liquidity, light volumes or whatever. Well, we're not planning on holding it all the way to that time period. We're planning on holding this for a couple weeks maybe. So I'm going to go at the money. Stocks at 320, 320. I'm going to sell that. I'm just clicking on the bid price. I'm going to look at my extrinsic value. And I'm going to go in the money. And my extrinsic value is about 880 or so. It's not going to be perfect. This isn't going to totally equal it out, but let's do like a 305 here, or a 305 strike, which is about 370. So I'm going to buy 2 of those. I'm going to hold down my control key. And I'm going to do it again. Okay, let's take a look here. We just move this up so you can see. Buying 2 in the money, selling 1 at the money. It's under the little pop-up thing there. And let's analyze it. Let's take a look. Analyze trade, make sure it kind of fits the bill, so to speak. Risk profile, make sure I don't have anything. Yep, and the stock's at 305. Excuse me, the stock's not at 305, the stock's at 320. And what if I do, this is today's date, that's right. Let me just set slices to break even. There we go. And you can see 50-50 basically, okay? It's a coin flip in terms of just probability analysis. That's why we do technical analysis. In theory, the technical analysis should help us out, okay? But if you're just going from a purely probability standpoint, that's what we have. It looks a lot like the Netflix trade, just in reverse. This one is an unlimited gain. The more I were to scroll over, the more Google goes up, the more money I make because I have more long contracts than short contracts. Okay. Down here, we cap our losses out. What's our loss? It's going to be there. It's an expensive stock. So we have expensive options, $2,800, $2,900 risk on that. And so, but if the stock does go against us, and we said we're going to exit if the stock goes below about 310, but even if it does, let's say it goes down to 305, our max loss here, okay, at max loss at expiration. Before expiration, there's a pretty good gap there, so we shouldn't be seeing nearly as big of a loss. But we're going to look to exit around 310 on this trade. Theta, yeah, time decay is working against us. And Chris says, is the idea of the zebra. Now, did I use the term zebra? Zebra stands for zero extrinsic back ratio. That's what it stands for. That's where we were doing the extrinsic value. Is we're trying to minimize the amount of the theta. Hey, look, when you do a long call, let's say we were just doing a long call on Google, on Alphabet, it's an expensive option and you're going to have a lot of time decay on it. There's just no way around that. The goal is to kind of try to minimize that. It's still significant, but there's potential significant gains. I mean, if you look at the scale on this, that's $5,000 here. I don't have a different scale. If I could tweak it a little bit, So it doesn't have to go up that far to get a $1,000 gain or $2,000 gain on this. I mean, it needs a significant move, but it's not an unrealistic move is how I would say that. So that's the price, the price you pay for that is to a certain extent is your theta on that. And there we go. I think that's that. Let's put that in, and let me just mention, we said we were doing the long 305s, December 26. If we just bought the call, it would be about $1,900, a single long call. That's your risk on that. So again, while our risk is going to be greater on the back ratio spread, remember, our break even on the back ratio was right where the stock was at, 320, essentially, pretty close to that. What's our break even going to be if we just did a long call? Well, if I did a long call, sorry, let me compare apples to apples. I did the wrong strike. I should have been looking at the 305 strike. My break even is going to be 19 plus 305, so about 324. So we need a little bit more movement on that, not a huge difference on if we were doing the long call to hit our break even point. Oh, there's a survey link in the chat, by the way, everybody. So we do appreciate your feedback on that. So that's our break even. Yep, Chris says. So that's, by the way, if you're doing a long call, that's how it is. Long call, take the strike, add the cost. That's your break even. Long put, take the strike, subtract the price of the option. That's going to be your break even on that. Okay. So there we go. Let me go here. Let's put in that trade with, let me create an opposite order. Market, GTC, we're going to get out, I wrote it down, if we're below 310, Google marks less than or equal to 310. I'm going to save that, do that, send that, okay? And it's thinking. That, we'll let that fill. We'll let that sit for a minute. Now, last thing, it just filled. Last thing before we go here. This is a back ratio spread we're covering today here, everyone. Back ratio spread. Let's look at last week's trade, because last week we did a front ratio spread. Remember, kind of the bummer thing on the front ratio spread is that the downside of the front ratio spread is the unlimited loss. Well, in this case, we're actually doing pretty well. We're up on NVIDIA here. It's cooperated. We're not under 10 days on this, but let's look at NVIDIA. Let's just go to the Analyze tab. I've got to wrap up with this and take a look at our trade. This was our trade from last week. Okay. And this is NVIDIA right now is at 181. It's right here. It's doing fairly well. If the stock goes up, great. And if the stock goes down, it shouldn't hurt us too much from where we're at. So I'm willing to let that sit a little bit longer on this. Once we get under 10 days, we did this 2 weeks ago. I said last week. I think last week was a holiday, so we did this 2 weeks ago. Once we get under two weeks, we'll look to get out. So I'll either look to close this out in next week's Managing Options Portfolio class or in this webcast next week there. Okay? All right, so that was last week's. We added 2 this week, back ratio spreads. Just as a reminder for you, if you're interested, here's kind of the ground rules that we used in this webcast, at least, for those back ratio spreads. And last question, Quentin was asking in the scan where the penny increment options is. Just go to intersect with, and you can do that right up there, okay? It's in the public watch list. All right, everybody. Hey, thanks for joining me today. Appreciate you. Coming up next, we've got market and sector analysis. I think Ben is teaching that this week. And appreciate your time. I hope you all have a wonderful weekend. James, thanks for helping me on the chat, of course. And remember to follow us on X, @BrentMooreCS, @JamesBoydCS. And we'll see you all same time next week. Bye-bye, everybody.